Donald Trump's Liberation Day U-turn, what are the consequences? Okay, so hello and very, very warm welcome to our latest urgent market update video for Friday, the 11th of April. The whole point of this brief video is to discuss Trump's Liberation Day U-turn. We'll explain what that is, what that consisted of, more importantly, what the market response was, and why we saw the moves that we've seen over the last week or so, and ultimately discuss what are the consequences, not just what we've already seen, but what we're likely to see as we progress over the course of the coming days and potentially weeks. So hopefully you'll find this useful. If we could start, as we always do, with our risk warning, take a brief moment to familiarize yourself with our risk warning currently up on screen. Do feel free to pause this video if you need. Okay, so let's get straight into it then. So what we'll do is we'll start with on the 2nd of April, which was only 9 days ago. You're probably more than familiar. You've seen it all over the news. Liberation Day for the US. And it was based around reciprocal tariffs, as you can see. Now, that very concept, standalone concept, is slightly misconstrued, because Donald Trump himself, when he refers to reciprocal tariffs, he's used the phrasing, you know, we will charge them what they charge us. Now, that's where you run into a little bit of difficulty when you're talking about reciprocal tariffs, because what he's referring to is trade deficits. And the bigger the trade deficit, the bigger the penalty was in terms of tariff. So these numbers, which is tariffs charged to the USA, is not technically correct in any way, shape, or form. It is more to do with the outstanding trade balance between the relative countries. And as you can see here, China has an exceptionally wide trade balance with the US. And as a result, they've done the calculation to work out that China are charging the US 67% tariff on imports into China, which is absolutely not the case. So as a result, Donald Trump put forward his reciprocal tariff, which is not as bad as the tariffs that they're charging, which, just to confuse you, which they're not technically charging. It is a trade balance, a discussion around trade balance. And these are all on the right-hand side. In the yellow, of course, are all the tariffs that the US decided to impose on nearly every country in the world. So that was the context for all the chaos, and we'll have a look at the actual charts in just a moment. However, again, you're probably familiar with the U-turn, which was only 7 days later, Wednesday, April the 9th. This is Liberation Day, and this is the U-turn that we have seen. And you can see country by country, you can see the originally threatened percentage, and you can also see the updated rate. Now, we'll discuss China in just a moment, but you can see all the other countries, they've had their Liberation Day reciprocal tariff reduced quite considerably. So we've removed the complications around reciprocal tariffs, and the US are now just opposing 10% tariffs pretty much versus nearly every nation or group of nations in the world, down to that 10% level. So they've added a 10% levy onto all imports into the US as standard. Now, this is the broadest and widely imposed tariffs since the 1930s, again by the US administration. So we haven't seen this type of move play out for quite some time. Now, that's quite important in terms of how financial markets are likely to react to this. So with that in mind, let's have a look at the reaction firstly in the markets. So we'll have a look at the S&P 500. And to just put this into some context, we just identify, it was interesting to see on that Wednesday, the 2nd of April, it was quite interesting to see that actually these markets rallied a little bit to begin with. And then they all rolled back over to the downside. So we had a little bit of a pop, and then we saw over the next day and a half, not even day and a half, 24 hours, 25, 26 hours perhaps, the wheels came off. And this is from a high of 57.32 down to 48.03. So you can see there, you're talking about 900 point move in just 26 hours, let's say. So that's quite a considerable move. You can see the average true range is about, sorry, this is actually on a, let's just have a look at it on the daily time frame just briefly. So in an average day, you can see the ATR in here is close to 192. And that's really taken into account the considerable volatility we've seen over the last week or so. So let's go back to a time where we didn't see that much volatility. We'd have a normal average true range of about 80 to 90 point move in a day. And we've seen 10 times that just in 26 hours, just over one day, as you can see. So we've seen 10 times the volatility around that initial reciprocal tariff implementation, which was due to come into effect from the 9th of April. So that was the initial market response. And then we got a bit of positive news. There was a bit of a fake news whisper, which at this point here, in the space of about 1 hour, we had prices selling off aggressively, and then they reversed very, very significantly. CNBC put out on the airwaves that Donald Trump was going to put a 90-day pause on these reciprocal tariffs, and markets reacted in a remarkably bullish sense. Now, this in itself, in the space of 2 hours, is somewhere in the region of about 400 point rally, about 600, perhaps 700 point round trip in the space of just a couple of hours. So we are talking about extreme volatility and a lot of fear and anxiety kicking in. But what this event on Monday the 7th, what it did lean into was the fact is, what if Donald Trump did actually decide to do away with the reciprocal tariffs? Well, we got the initial market response. It would probably react in a very, very positive manner. And that's pretty much what happened. So didn't make any further progress on Tuesday and Wednesday. And then towards the latter part of Wednesday evening, Trump made the decision to make an announcement to these markets and said he was actually going to impose this, going to remove those reciprocal tariffs to those that didn't retaliate to the US decision around reciprocal tariffs. And he's really pointing to China. We come back to China in just a moment. But we did actually see the biggest rally in financial markets since 2008. So, this type of volatility doesn't happen that often. And this is a very significant, momentous occasion for financial markets. So, and that was just as that was Wednesday evening that occurred. Now, since then, there's been this little bearish response to Wednesday's really bullish market reaction. And this is where government bonds come into play and start to play a very, very significant role. So at this point, if I can perhaps bring up the 30-year first, the 30-year Treasury. So normally during times of excessive risk and fear and anxiety, you often get the financial market moving towards safe havens like US government debt, because it's one of the safest instruments out there. And what you generally see is a demand for government bonds, and you can often see prices, edging lower. But what this has now become is this has become one of the more riskier assets out there by a country mile. And I'm just conscious, even as I'm recording this, that this 30-year Treasury note is continuing to move higher to the upside. And if we zoom in, you can see that these bond yields have been rolling over to the downside. But it's the fact that we've rallied from basically 4.36 at the lows up to nearly 5% in such a short period of time. And the reason for that, and the longer end, those who participate in the purchasing of bonds at these longer rates are all your financial institutions and insurance companies and your mortgage brokers and all your institutions, and and governments as well, long-term debt purchasing. And it's over a 30-year period. And what we're finding is that these financial institutions seem to be dumping their bonds, and as a result, we're seeing a pretty drastic move to the upside in these government bonds. Now, we do have to speculate in terms of why that's happening. And what appears to be the case is that the markets are beginning to lose patience with Donald Trump and the way in which he's conducting his business. I don't think anyone thinks it's grossly unfair for the US to negotiate, tariffs of some kind. It seems to be more about the way he's going about his business. And it's causing a lot of fear and anxiety, even on a 30-year US Treasury note. It's still experiencing the fears and anxieties that you'd probably expect on the lower end, the more near-term government Treasury bonds. So it's just showing that, and again, this is continuing to tick higher, which is becoming a bit of a problem for equity markets, and we'll explain why in just a second. And if you compare and contrast that to something like the 10-year, that's climbing as well. And again, it's the move that we're seeing in a remarkably short period of time, from basically 4% to 4.56. And again, it's this dumping of US government debt, and it's causing these bond yields to rally, increasing the risk for these financial markets. So that creates a very, very interesting dynamic, and that for us is the major reason why Trump carried out the U-turn just 7 days after imposing Liberation Day. So he did a U-turn because one of the problems with elevated bond yields and the fact that they're moving higher in such a rapid pace is that can very, very quickly escalate out of control to the point where the cost of refinancing the debt becomes considerably unsustainable very, very quickly compared to the amount of revenue that the government are bringing in through tariffs. So you don't want to have a situation as if you're imposing tariffs to bring in cash into the treasury, and they're bringing it in through tariffs, but giving out more through refinancing the debt, the massive debt that the US has to pay. Excuse me. So you don't want a situation where you're paying out more than you're actually getting in. And this is what the markets seem to be doing with the, I suppose, the ultimate the way in which the US administration are conducting their business in terms of responsibility for the economy. It's kind of seen as a bit of a reckless move, reckless behavior, and the financial markets themselves can hold individual politicians to account in a very, very significant way. You just got to look at Liz Truss in September of 2022, came out with Kwasi Kwarteng and the mini budget, which was regarded by most bondholders as being, putting it politely, unachievable to a large degree, based on this principle of growth out of thin air. the financial markets didn't like that. We saw government UK government debt bond yields rally very, very aggressively. We saw a massive decline in UK equities and a crash in the pound. So until the Bank of England stepped in to plug the gap. So this is what's at stake. And even while we're broadcasting, this number is continuing to tick higher, which is a bit of an interesting development for these markets. So with all this in mind, what does that mean? If financial markets distrust the US administration to deal with the economy in an effective way, where the wheels don't come off, we don't head into a very significant recession with unemployment going up, growth coming down, inflation ticking higher because of these tariffs. So the bond markets are suggesting us that there's some significant developments ticking away, probably in the background, and it's effectively a ticking time bomb for these markets. So what does that mean for indices? Well, it means we probably only have more downside to focus our attention on. So our bias, although we had a massive rally on Wednesday, is actually more to the downside than it is to the upside. So we're not too sure the bounce is really what we're looking to try and take advantage of. So outside of the US indices, and that same analysis can be applied to the NASDAQ and the Dow Jones, that we're going to just watch these markets very carefully to see if we get some opportunities to start selling. But also look what's happened in markets like the dollar. So one of the, and again, if I just bring up this image, because it's quite important to see, and if I just take this back just marginally, we just take that back there and look at this, what's written here. So tariffs charged to the US, including currency manipulation and trade barriers. So it's this currency manipulation that's really quite important. So as we know, Donald Trump has mentioned that countries are bending over backwards to see what they can do so that they're not hit with this tariff. And I'm pretty sure one of the discussion points is, right, well, look, dump your dollars and devalue your own currency so that the dollar weakens and we become a little bit more competitive from a currency exchange perspective. So it's one mechanism for the US economy to become more competitive, as if their currency is cheaper. So as a result, we're seeing the dollar weaken across all major currencies. The euro, we're at new highs. The pound, we're very close to all-time highs. We got new lows in the dollar yen, so strength against the yen versus the dollar, and the dollar CAD is at new lows against the dollar Swiss is at new lows, and the Aussie and the New Zealand are trying to retrace some of the weakness that those currencies have seen, over the last week, and they're pretty close to rallying as well. Because of this nervousness, if you look at markets like gold, it's a severe just upward move, and you can see the volatility and the volume gone from 3,000 up to 3,228 now. So some of the moves in these markets are excessive, and again, like the US indices, we've only really got a downside view of markets like crude oil, more so over the short term. So to conclude then, what we would probably expect is for further weakness across the indices and further weakness across the dollar until something significant changes, with really and further downside as well for markets like crude oil, and you'd have to say with the uncertainty, further upside for gold. So with all this in mind, and we're going to be watching these bond markets very, very carefully indeed, and we're going to see how these updated rates. Just quickly on China. China is kind of a unique situation. So I don't think many are surprised for the US and China to be going at each other the way that they are. And apparently this updated rate now is up to 145% on all Chinese imports into the US. So it's a really significant trade war dynamic. And we're going to have there's consequences for the global economy just as a result of the trade war between the US and China as well. And we want to see how that plays out. But we will get some update over the coming days and weeks about how these baseline tariffs, 10% applied pretty much across the board. So whether you're in the UK or across the Eurozone, Vietnam, Taiwan, South Africa, Brazil, Israel, Philippines, we've all been hit with a 10% tariff on imports into the US. Okay, so that is a detailed breakdown in terms of this U-turn that we've seen from Donald Trump. We've already seen the excessive volatility to some degree, and the consequences are we're seeing a strong rally in US bond yields. We're seeing a lot of these government bonds being dumped onto the market. You do need buyers of these bonds, which is why these rates are going up at the rate in which they are, because you may struggle to get buyers at times like this. And what you can see is a bit of a credit crunch dynamic forming. So we're not out of the woods by any stretch just because Donald Trump has decided to be humbled a little bit by financial markets. Finally, you'd wonder why this wasn't a thing a little bit earlier. And I think you're getting a lot of financiers now coming out saying we misunderstood Donald Trump. We thought he'd have the interest of the economy at heart. We thought he was a supporter of stock markets, and he seemed to have made a series of decisions that people are now rethinking that basic principle. So now the risks are getting excessively increased. Expect more volatility. Okay, that just about covers it then. So thanks very much for joining us. Any questions, do feel free to email us at support@thelivetraderoom.com if you do have any further questions. And we, of course, thank you sincerely for joining us, taking the time to listen to what we have to say about these markets. It has presented some phenomenal opportunities for us, and we want to share those opportunities and discuss these things so that you can perhaps take advantage yourself if you need. So on that note, we look forward to perhaps you joining us for the next video. So from everyone here at the Live Trade Room, take care, and we'll speak to you soon. Bye for now.